Okay, here we're going to be looking at a consolidation here for a sales type lease between a sub corporation S here and a parent corporation P here. And we're going to be looking here at the journal entries here that we record here at the inception of this lease. And what I'm going to be doing here is using the same procedure as a direct financing lease, except there's going to be a profit or loss involved when using the sales type lease. So let's look at our example here. Corporation P, the parent, has an original cost on a machine here of $11,700, and now it has a fair value of $10,800, or that is its book value here. And they lease it out here to Corporation S, the subsidiary, on 1/1/X1 with rental payments of $4,000 per year at the beginning of each period or the beginning of each year. So let's go up here and look at what we have to do. We have to set up an amortization debt schedule here. So we have a machine cost here of $11,700 and a payment due at the start of the lease year $4,000. So that gives us here a balance of $7,700 on this lease here. So this is where we set up our amortization debt schedule here. We got our balance here of $7,700. Then we have our payment amounts here at the beginning of each year here, and then we have an interest expense here of 16%. So I have set up here this amortization here of the debt. And for our example here, we're going to actually be comparing our sales type lease here to a direct financing lease here, just for our example here, except that there's a profit or loss involved. Okay, now let's look first here at how the parent would record this lease here at its inception date or its start date here. So Corporation P here, this is on for the year 20X1 here, 1/1/X1. At the lease start date here, we have a lease payment receivable of $10,000. And if we go up here and look, those are the three payments that we're going to receive here on this lease. That was a total amount here of $10,000. And then they had received here a cash payment from the subsidiary of $4,000. And then those would be debited here. And then we have unearned interest income for a credit amount here of $2,296. Now if we go up here to our amortized debt schedule, that's the total interest that they'd be receiving here on this lease. And then we go down back here to our schedule here. We have an asset. That's a cost of the leased asset here of $10,800. Now that was the fair value or the book value of the machine here at the lease date that we are using here. So we have a sales profit in this case here, and we have to record that sales profit. It could have been a loss too, but in this case it's a profit. So to record that profit, we would take its cost here of $11,700 less the fair value of the asset here. In this case it was $10,800, and in this case it was based here on the book value here that the leaser was carrying. So we have a net profit here of $900. So we'd be crediting our profit here for $900. Now in the subsequent periods, and now this is at the end of the year here, 12/31/X1, we have a credit amount here to the unearned interest, or debit amount to the unearned interest income here, and then a credit to our interest income here for $1,232 in both cases. So the subsequent entries here for the interest receivable and receipt of the payments here on this receivable do not change because of the profit or loss that we'd recognize here on this sales type lease. Alright, next let's look at how the sub-corporation here would record this lease here. And what has to be pointed out here, the lessee, or in this case the sub-corporation here, is unaffected by the sales profit here that was recognized by the parent on this sales type lease here. So for the sub-corporation or Corporation S here, on the lease date here, 1/1/X1 here, they would record an asset release capital and asset for the capital lease here of $11,700, and then they have an obligation here on the capital lease of $7,700. That was the balance here on our amortization schedule. And then they made a cash payment of $4,000, and then at the end of the year of 12/31/X1, they had an interest expense here of $1,232, and then an interest payable here of $1,232. And then they would record here depreciation expense, and this was depreciated here. The total cost here, or the original cost of $11,700 over 5 years straight line. That gives us $2,350 per year. So they have a depreciation expense here. Debit that for $2,350, and then accumulated depreciation for 1 year. They credit that here for $2,350. So what I want to point out here is this lessee here. Their entries here are unaffected by this sales profit here. So the lessee would be going through the same entries here if using a direct financing lease or a sales type lease. Okay, now for our adjustments and our eliminations here for the consolidation of the parent and the subsidiary on this lease here. So the first thing we're going to look at here is what is the similar here, or the same between a direct financing lease and the sales type lease. These adjustments would have to be made regardless here of the type of lease. So first we eliminate any intercorporation expense and revenue, and then we'd eliminate any intercorporation debt and interest payable, and then the lessor's asset and related accumulated depreciation should be reclassified as a normal productive asset rather than property here under this lease here. So these are the items here that would be the same here for either the direct financing or the sales type lease, and you could reference these here by looking at the direct financing lease video here. But what we're going to look at next here are the adjustments that would have to be made in addition to these adjustments here that are normally made here, and those adjustments are going to be for this sales type lease here for the profit that was recognized. Okay, now let's look at the added adjustments here we'd have to make for this consolidation for this sales type lease, and these are the adjustments that we have to make due to the profit that we recognize here on the sales type lease. So first, looking at our lease adjustments here for the year 20X1, or the first year here. So first we have to reduce the cost of the asset for the gain here of $900, that $900 profit here. So we go up to our sales profit here for the lease, and we debit that for $900, and then for our property, plant, and equipment, we reduce the cost here by crediting that for $900. And next we have to reduce the depreciation expense here at $300 per year, and that's due to amortizing that $900 gain over 3 years here, or $300 per year. So we go up to our accumulated depreciation for property, plant, and equipment. We debit that for $300, and then we go over here for our depreciation expense, and we credit that here for $300. Okay, now let's look at our adjustments that we'd have to make here for 20X2 here, or the second year here of the lease for the sales type lease. So what we have to do is we have to adjust the remaining sales profit at the beginning of the period here. So first thing we have to do is we have to look at this retained earnings account here for the controlling interest, or that's the parent's retained earnings account here. So we debit that here for $600, and then we go to our accumulated depreciation for property, plant, and equipment. We debit that here for $300, and then the balancing amount here would go to a property, plant, and equipment here for $900. We'd credit that here for $900. And the next thing we have to do is we have to again reduce this depreciation expense here at $300 per year, and that's for that amortization here of this $900 gain over 3 years. So we go up here to our accumulated depreciation for property, plant, and equipment. We debit that for $300, and then for our depreciation expense here, we'd be crediting that for $300. And then a note here on this income distribution schedule here, and that would be for the parent corporation. Now they'd have to include the deferral here of this $900 profit in the year of the sale here of the lease, and they'd recognize $300 profit during the asset's 3-year life here, or the amortizing this $900 profit here over 3 years here for $300 profit recognized each of the next 3 years.